And we've seen many cuts to the outlook. Here's the latest from David Stubbs over at JPMorgan Private Bank. 42.50 down from 4,500. Goes on to say a good chunk of the recent decline in stock prices is attributable to a marked drop in distant earnings. As a result, we revise our year-end 22 S&P 500 outlook to 42.50. David, great to catch up, sir. Good friend of the show, good friend of mine. Let's work through it. 42.50. Why? Basically no gains for the rest of the year.
Well, sure. Good to see you, John. In discussions with our equity team, about the outlook, I think we see some margin compression ahead, for sure. We absolutely are in the camp that the growth is going to slow. Our economics team, pointing to sub 2% growth next year for the U.S. economy. You put those two things together, as well as some, some question marks over how high the Fed can go in their policy tightening. And you get to, as you say, a rather modest outlook for us. I think the point on the longer term earnings one is a very interesting one. As we've seen, next 12 months earnings have continued to grind higher over this year, and the equity team are absolutely pointing to sectors such as healthcare that have that resilience over the earnings pattern. But if you look further out, estimates of 3 to 5 years growth, which are present in the market, have come in quite a bit. And that, firstly, for us, reflects a little bit of a correction after huge optimism built up post-pandemic about some of these digital trends. But most of that now seems to have actually happened, and we've seen now that no reason why you can't have good productivity growth for this cycle. No reason why the long-run trajectory of America has changed. So I think that's an important aspect to this decline we've seen in growth stocks this year.
So David, last time we spoke, you said a softish landing is still the base case for you, and people will be struggling to reconcile that view with this view of limited upside on the S&P 500. How do you pair the market view with the economic view? You touched on it there, David. Just build on that a little bit more.
Sure, John, very simple. If nominal GDP is going to slow from its torrid pace in the last few quarters, and yet things like the labor market wage growth are still going to be reasonably robust, you get a compression of margins. And that's why you can have absolutely economic growth next year of below trend. Let's be clear, we're calling for, I think, 1.4% growth next year. That's below trend for the US economy. Whilst having a pretty muted earnings upside from here. And we will need, I think, to see a clear turn in optimism about corporate earnings, clear signs that the Fed won't have to go, say, above 3%, clear signs that margins reach a bottom before the equity market will rally sustainably. Now, look, in that time, John, you're going to have tradable rallies. And if you're watching this program and you're a trader, I'm sure you can absolutely make hay in those. But before long-run investors really find a bottom, I think they need to see a few of those things together. So if you put a weak GDP number on earnings growth, it really happens to be not the most exciting outlook for equities on a market-wide level, but certainly some opportunities now for traders and indeed for some long-run investors.
And on the other side, in fixed income, in bonds, David, are you more confident in this idea there's more upside in treasuries than perhaps there is in equities, that we can get a decent rally here in treasuries now, that this is the place to be again, that bonds are back? Can you say that?
Absolutely, John. We've been saying that for a few weeks now, having a lot of conviction that when the 10-year is north of 3%, it's time to add, especially if you're holding a lot of cash. I think this represents an important evolution in the market drivers. Last year, 3 to 4 to 5 months, we've seen bonds be the issue. They were the ones selling off, raising the discount rate, hurting the equity multiple. We're probably at peak hawkishness right now. We think that the correlation has started to flip. The bonds can protect again, and so we are advising adding to duration when you can get more than 3% on a US 10-year. Don't get me wrong, certainly further losses would be possible if the inflation proves a bit stickier, and Friday's CPI report absolutely crucial there. If you get more hawkishness around the world, the ECB tomorrow, for example. So it's obviously not a one-way trade, but we think there's an asymmetry here that if you are looking for a severe slowdown in growth next year, bonds are going to help protect your portfolio in a way that they haven't in the last 5 to 6 months. So that's an important evolution now. Now the focus is on how deep will the economic slowdown be, how deep will the margin compression be. We're obviously pretty cautious on those fronts, and that's why we're advocating clients that don't have a lot of duration in their portfolios to start to add.